Straight to business, Sean Pellegrin here, starting with a look at the oil markets.
Yeah, the Iran war continuing to fuel volatility in crude prices, and that Strait of Hormuz still closed to virtually all tankers attempting to leave it and supply international markets. That's the main reason behind that 50% or so increase since the U.S. and Israel launched their missiles against Iran on February 28th. Right now, the Brent and WTI moving in slightly different directions, and they've whipsawed this Tuesday morning on a number of different events. They were up after U.S. President Donald Trump threatened to obliterate Iran's energy infrastructure, and investor sentiment worsened even more after an Iranian drone struck a Kuwaiti oil tanker off the coast of Dubai. But then prices fell on the back of a Wall Street Journal report saying Donald Trump has told aides he'd be willing to end the war even if the Strait of Hormuz remains mostly closed. In terms of stocks, we've seen a volatile session in Asia, with the Kospi in South Korea leading the losses, down 4.26%. The Shanghai Composite also lower as China's factory activity returns to growth, expanding at its fastest pace in a year. In Europe, we're seeing a mixed open amid all of that uncertainty surrounding the Iran conflict and whether there's going to be escalation or not. The Paris CAC 40 down just under the flat line.
Yeah, the surge in oil prices, of course, raising concern over inflation spiking again. What are we seeing on that front, Sean?
So on Monday, we saw German inflation accelerate to 2.8% year on year in March because of the Iran war, from 2.0% in February. And we're seeing a similar uptick for France, with the latest data shared this Tuesday accelerating to 1.9% from 1.1% in February and 0.4% in January. The key factor here, energy prices, which have gone up 7.3% annually, according to the latest data. This will add pressure on the French government to potentially intervene for French consumers, even if public finances are very tight. It will also factor in the European Central Bank's decision-making when it comes to interest rates. As a reminder, target inflation stands at 2%, so we're still under that target for the time being.
And in fact, the global economic shock is really prompting all sorts of different governments to step in with extra measures.
In South Korea, for instance, the government of President Lee Jae-myung is proposing a new supplementary budget of 26.2 trillion won. That's about 15 billion euros. The new spending plan includes a consumer voucher scheme that will be worth about 50 to 340 euros per person, depending on their income and the region they live in. And excluding the top 30% earners, South Korea is particularly exposed to the war in Iran. It's the world's fourth largest importer of oil, and 70% of that oil comes from the Middle East. This has prompted President Lee to call for a faster energy transition.
Let's take you to Australia for something different now. The government there is threatening to sue top social media companies.
The country's e-safety commission is accusing Meta, Google, Snap, and TikTok of failing to comply with a recent law banning kids under the age of 16 from their platforms. That groundbreaking law took effect 3 months ago, and many countries, including France, are looking to follow the lead set down under. Brian Quinn has a story.
3 months into what should be a new era for Australian kids, Canberra says the world's top social media firms are not playing by the rules. The country's e-safety commission preparing potential legal action against tech giants for flouting a ban on kids under 16.
The tricks eSafety has uncovered in their compliance update are straight out of the big tech playbook. And Australia will not let the social media giants take Australians for mugs.
The ban took effect in December amid growing concern over social media's negative mental health effects, as well as its addictive algorithmic designs that have many kids and adults spending hours per day on their phones. Regulators say some 4.7 million accounts were removed or restricted in the first month alone, but plenty of children have been finding ways around the ban. Roughly a third of Australian parents say their kids still have social media accounts. Specifically named in the accusation are Meta, which owns Instagram and Facebook, along with YouTube owner Google, Snap Inc.'s Snapchat, and TikTok. The government says their compliance has been substandard, citing platforms prompting kids to retake age assurance tests, allowing users to change their listed age after sign-up, and failing to use age estimating technology. The companies face fines equivalent to 29.5 million euros per breach of the law. Meta and Snap say they're committed to obeying the ban. Social media firms are coming under increasing legal pressure worldwide over mental health and addiction. U.S. juries recently awarded civil plaintiffs significant damages, while roughly a dozen countries are preparing youth bans similar to Australia's.
Brian Crane reporting there. Sean, thanks a lot with the business news.